Good afternoon from Singapore. We are here at our research conference room. Senior rate strategist Eugene Leow and FX and credit strategist Chang Liang, and I'm Temur Beg, chief economist. Welcoming you to our November Macro Insights Livestream. It's been quite the week, gentlemen. The election of Donald Trump, or rather re-election of Donald Trump, and associated impact on markets have been seismic, to say the least. What I'd like to do is talk a little bit about the election impact, as well as our 2025 annual outlook publication, which we released last Friday and presented to our clients as well. And then I have Eugene to talk through some of these Trump trades that are taking place, and Liang, who follows FX and credit as well as crypto for us, will weigh in on that space as well when their turn comes, his turn comes. So this is our lineup. I'll talk about the 2025 outlook. After that, Eugene, who will talk about the all-important question of where the neutral rate is going with all the Trumpflation being priced in, and what that means for Fed as well as the longer end of the curve. And then, as already anticipated, Trump trades on the crypto, China, and the dollar. Liang will touch on all that. A couple of pointers for all of you. I have on the screen right now the QR code for your questions. I just actually checked that website. Some of you have already submitted some questions, so thank you for that. We certainly will set aside some time toward the end of this discussion to address all of your questions. If you cannot scan the QR code, go to dbs.pigeonhole.at, enter the passcode macro, and it will accomplish exactly the same thing as scanning the QR code. All right, and we will come up with this QR code later on as well. Yeah. So don't think too much about who means what for longer term asset market returns. There, I think, as important as policy is the underlying macro fundamentals. If you look at Trump's first term and Obama's two terms, first of all, Trump and Obama could not be more different. A completely different way of governing, completely different commitment toward foreign policy, domestic policy, etc. At the same time, when we look at Obama's 8 years of equity returns and compare that with 4 years of Trump's equity returns, can't really see much daylight between them. On an annual average basis, both presidents presided over incredibly good stock markets, returning about 19 to 20% annually during those days. Bush 43 was unlucky. His term coincided with the dot-com bust. So that also tells you that independent of the policy, if a major non-policy related event happens, which is what happened in 2004, the dot-com bust, you could end up having a really bad 4 years with respect to the stock market. This, in my view, is actually a warning for the next 4 years, that by the time Trump comes to power on the 20th of January, we may have actually all the gains registered, and that'll all show up under Biden's term, not under Trump's term. And then there might be actually some of the very high they go and then very hard they fall phenomenon under Trump 2.0. We'll see about that. But the main message here is that there isn't a Republican bias or Democrat bias as far as stock market returns are concerned. Clinton's term was much better than the Bush and Reagan terms. But you could argue Trump's term was slightly better than Obama's term, and maybe, at least so far, slightly better than Biden's term. But in all cases, with the exception of Bush 43, stock markets in the U.S. do pretty well, independent of the day of the U.S. election and the following 4-year time frame. One more QR code for you. This is our 2025 publication, Defying the Trend. The QR code will take you to the publication and our 13-country overview, as well as 5 asset class rundown of what we think are the key forecasts as well as strategies for 2025. Everybody in the team, about 19 of us, have contributed to this report. Please do take a look. And we do also have a LinkedIn post supporting that right now. Okay, so what I'm going to do now is do a quick run through of the key countries that we cover here at DBS Group Research, and just give you a sense of where we stand instead of giving you a wide range of forecasts. Some of them will be presented in a table that I have at the end, but just a sense of where we stand on the macro cycle. On the US, job creation is still healthy. We will step into this new presidential term with strong growth momentum, very strong asset markets, very resilient corporate and housing balance sheets. We have seen some worsening of credit card debt numbers, but it's marginal compared to the net worth improvement of U.S. households. Same with corporations, very strong earnings the last 4 years, and they will step into 2025 feeling very good. Goods inflation has dissipated. Oil is on its knees, and therefore, although we have heard a lot about how this election was about cost of living, the irony would be that we probably are at the fag end of the good sort of inflation. We would need additional policy impulse for the next round of inflation. We think there will be policy, but independent of that, we probably would have called inflation as one of our lesser worries going into 2025. Trump changes that, but that's what Biden would have had as his legacy if, let's say, Harris were to get elected. Lots of risk in the horizon. What would Trump do with fiscal? How far would he go with trade war? How far is he going to restrict tech access for China and countries that do business with China? What about foreign policy with respect to Ukraine, with respect to the Middle East, and the entire South Pacific? The kind of hawkish personalities who have been named in the Trump administration so far makes one think that whatever fears that we have, they might all come true. We will confront a very inward-looking, but at the same time hostile U.S. going forward, at least judging by the foreign national security advisor, Secretary of State, UN ambassador type appointments that have been announced in the last 48 hours. On FX, we think that for the short term, at least, there is just only upside for the US dollar. We will talk a lot about this in Eugene's sections about what it means for rates, but there is a same side of the coin situation with respect to rates and USD. If we expect higher rates, of course, we should expect higher US dollar. So anyway, more on US later when Eugene comes in, so let me just move on. All right, that's another way of doing it. China. Our team, Moji, Byron Lam, Nathan Chow, and Samuel Say published their China outlook just a couple of hours ago. Those of you who have access to our website, I encourage you to look at it. It's a very good report. The key point in that report is whatever stimulus measures we have had from China this year, and this has been substantial, especially since September onward, they would help China register 5-ish growth for 2024. To get 5% next year, we will need all of these stimulus measures to sort of work through their system, and there probably would be additional stimulus in the pipeline. The problems with the housing market, the weak domestic consumer sentiment are too big to rest on one or two large stimulus measures. We may need successive measures, not to mention the fact that now China has to think about offsetting the big trade-related restrictions that might be coming from the US. Our team has done some back-of-the-envelope work. If indeed Trump follows through with 60% tariff for all Chinese exports, it would hurt the Chinese economy tremendously. And especially given that in 2024, a very large chunk of China's growth will actually come from net exports. In 2025, if those tariffs were to go through, that would probably turn into zero, which also means about 1%, 100 basis points of growth can be shaved off from the China forecast for 2025 if a full-blown 60% tariff is imposed by the US. But why are we then not forecasting 4% for 2025? Because we think there'll be more stimulus. So that's the point. It's not a one-off game. There are reactions to the actions. There are endogenous policy mechanisms in place. The tougher the US gets, the more expansionary China gets. China is not like the US. They don't rely on foreign investors for the debt issuance. At the central government level, debt burden is nothing compared to the debt burden of the US federal government. And therefore, China does have room to expand. Many people have been telling them to do that. They will now certainly follow through. We are sure about that. This has implications for RMB as well. But then again, Liang and Eugene can weigh in on that later. On Singapore, our home turf, it's been having a very good 2024. Investment flows to Singapore are breaking records. Investor enthusiasm in a country that is so small, so expensive, is suffering from so much land power crunch, and still there is no relent in foreign investors' enthusiasm in Singapore. Singapore's economy, from FDI, from consumption, from tourism, is firing on all cylinders. Probably will end up growing by close to 3% in 2024, and we're equally constructive about 2025. Singapore has found a new source of momentum in high-end precision manufacturing, particularly semiconductors and data centers. Singapore has a major structural driver of medium-term growth in the form of signing this special economic zone with neighboring Johor. So lots going on in Singapore. Of course, a country that has 200-300% of GDP trade GDP ratio is very vulnerable to trade war, would be hurt by trade war, no question about that. That's the way Singapore operates, but at the same time, the country has created buffers, has created a domestic, highly attractive investment environment, which will hold Singapore in a good position, regardless of how bad things get on global trade side in 2025 and beyond. On India, which is the darling of investor community, there is some dissipation of growth momentum lately. There's some disappointment in the markets that the RBI is not in a position to cut interest rates quite yet, despite the fact that Fed has already cut 2 times. And that's for good reasons. There is some supply side inflation pressure in the country. Rates are, by historical standards, not particularly high. So dealing with inflation right now sort of makes sense, even if that means growth is to the lower end of the 6 to 7% spectrum. But as far as medium-term drivers of investment, consumer sentiment, capital market activity is concerned, India is looking very good. So I wouldn't worry about the near-term wobble. There are other things to think about, not just the issue of sticky inflation. There is a question of India's farm-level productivity and farm-level output, given its rising vulnerability to climate change, remains to be seen. And also how India sort of balances its relationship with China and Russia, while the US has this new leadership, will be also very interesting to watch. In the last 6 months or so, we've seen India becoming a little more pragmatic vis-a-vis its relationship with China. And of course, it's been very engaged with Russia with respect to importing oil from there. How India manages to continue with those strategies under Trump, let's see. On Hong Kong, country or city-state that does not need high interest rates at all, but because they are linked to the US dollar through their currency board, they have to. It's been a tough year. Anybody who looks at Hong Kong property sector, domestic activity know that high interest rates are hurting the economy. The authorities are trying to ease policy, and they, of course, are accommodating 100% of whatever the Fed is doing. And the question is, has the domestic real estate sector corrected sufficiently? Has the domestic price level stabilized sufficiently to bring back interest in real estate as well as foreign tourism into Hong Kong? Hong Kong is doing what it can, given that the tough tightrope that it has to balance. And in terms of doing what it can, it is opening up the economy to immigration, which is not the case in most parts of the world. And they have been successful in getting a lot of professionals from mainland China, from Philippines, India, etc., to come to Hong Kong, just as the time when the rest of the world is sort of turning more and more closed. So I think that we should not give up on Hong Kong. I think the economy still has dynamism and probably has room for upside surprise in 25. Quickly, Japan and Taiwan, 2 countries which are sort of at the heart of the tech war, but they're sort of on the right side of the US. Japan and Taiwan, both very strong allies to the US. Japan will probably go opposite the global trend. They need to normalize interest rates. Their growth is decent. Labor market is in good shape. Wages have picked up. Excessive yen weakness is becoming a bit of a question for the BOJ. So we do think that they will hike rates next year. Of course, no shortage of political drama in Japan, no shortage of structural reform that are pending in Japan. But as far as the cycle is concerned, we do think one should be expecting rates to go up, and therefore we remain long the yen, independent of the very recent weeks when, again, the yen has capitulated against a resurgent US dollar. Finally, on Taiwan, the epicenter of tech excellence in the world. Some of the things they do, nobody in the world can do. The tiniest chips in the world, not the Americans, not the Chinese, not the Japanese. Only the Taiwanese can make, and it's basically TSMC. It's pretty remarkable, and that, of course, is Taiwan's shield. That allows them to get huge amount of support from the US, and that also creates a lot of consternation in China. I was speaking with Ma Tiying, whose picture you're seeing on the screen. She is our Taiwan specialist, just before this call. And she was telling me that even till a few years ago, Taiwan specialty was making very tiny chips, and then those chips would go to Malaysia, China, elsewhere, and become part of servers. Now those AI servers are being made in Taiwan. So Taiwan is also offering a better value proposition on the back of their comparative advantage. All right, so that's the end of my country overview. Before not fully over, let's not forget good old Indonesia with President Prabowo taking the helm. Good to see Sri Mulyani Indrawati continuing as finance minister. We're happy about that. We're a big fan of her. And we think that the political transition is right now going to give a bit of breathing room to the Indonesia markets. We think that the president has come with high expectations of taking Indonesia to a slightly higher level with respect to regional engagement, with respect to green transition, and perhaps even supporting manufacturing. Let's see how Indonesia does, promising well. Now it's a question of President Prabowo and his cabinet to deliver. Overall forecast, again, as we said earlier, 5-ish growth in China in 25 on the back of 5 in 2024. At the very bottom of this table is the US forecast. We're looking at 2.5% growth in 24. Really pretty remarkable given how late we are in the cycle, and maybe so around 2 on the back of slight weakness in labor market. And that would really be the case if Trump ratchets up anti-immigration measures and starts getting rid of labor. I think that could be a problem for some industries and lead to some slowdown in the economy. Inflation, we do see some base effect related additional disinflation in 2025, about 2.25%, but we think there is some upside to this outlook, especially again, if Trump does large-scale tax cuts and imposes huge amount of tariffs, that 2.3 could easily become 2.5 or higher. Very good. As I said earlier, please send us your questions. I kind of went very fast through the countries in the coverage because I do think we have a lot more flesh for Eugene and Liang to unearth with respect to the markets. We'll come back with a Q&A later on. Thanks very much. Eugene, all yours.
Thank you very much, Timer. So I think right now, in terms of the rate space, we just want to have a good idea of where we are currently standing. And this 4 quadrant is something that I've showed for quite a while. And I think we're still pretty much in the Goldilocks zone where inflation is still cooling off and we have growth in the US still holding up relatively well. We've gone through a lot of scares over the past 2-3 years, be it stagflation, overheating risk, recession. These things come and go, but by and large, even as the market swings, if you look through the data over several months, things are still pretty much okay. So Trump's re-election changes things. Right? A lot of it for now is expectations. They could be a bit lofty. But in terms of direction, we are wary about tariffs, tighter restrictions on immigration, tax cuts. All these things offer upside risk. So I'm putting where are we, right? The black rectangle there, slightly tilting higher, right? We're still in Goldilocks zone, but there are some risks that we might be going up to the upper left quadrant. And so in terms of the cycle, when we think about monetary policy, for the most part, right, over the past 1+ years or so, we have central banks keeping interest rates steady. Right? And the whole reason was to make sure that rates are high and then it is restrictive and sufficient enough to bring inflation down to a level where the central banks are happy with. So for the Fed, they kicked off with a jumbo cut, 50 basis points in September. And the rationale behind that is, well, inflation has dropped below 3% for both headline and core. So with inflation cooling off, there's no need for the Fed funds rate to stay at 5.5, right? We could begin cutting them. And then the next logical question would be, at what point do central banks pause? Because the rationale for cutting would be to bring things to neutral because there's no big crisis. Right? If there's a big crisis, we will get more extreme measures, aggressive easing. But if things are okay, then we need to find a neutral rate. So where is the neutral rate? And this is a question that a lot of central banks across the world will be grappling with. Right? So when we think about interest rates and policy settings, anything red in this chart here shows where interest rates are high. So this is something that spans across the G10. 7 out of 10 have begun easing. There are a couple of exceptions where if you look towards the left-hand side, they're not green. The big one would be Japan. Japan, as Timer mentioned, really is an outlier. They have been very slow in the cycle. They've in fact been so slow such that when everybody else is cutting, they will still have to continue normalizing. right? So the road to normal for BOJ is higher rates, or the road to normal or neutral for the other central banks is lower rates, right? So this will be where the big divergence are. Another call out could be the RBA. So the RBA also has been a lot less hawkish than many of the other G10 central banks in this cycle. And against this kind of backdrop, if you have not hiked that much, then there is less urgency to cut, and there's also less room for you to cut. So that is where we are, right? The assumptions behind what the economy is likely to do, the inflation, and what central banks are doing, right, on where the path are going. And yet, there are certain things that introduce risk, right? So the US elections, there are 4 scenarios, and the outcome, Trump becoming president, and then it looks very, very likely that both houses will sweep a Republican. Right? So if you look at things, whether on the tariffs, corporate tax, growth, inflation, fiscal policy, everything swings towards a lot of upward pressure on interest rates. Now, a lot of it is expectations. We don't know what Trump will do exactly when he comes into power on January 20th, right? Depending on how he prioritizes things, depending on what comes out first, risk appetite might shift, right? But if we look across the medium term, meaning 1, 2, 3, 4 years, then we are facing a scenario where the rates pressure is theoretically the highest, right, under this election outcome. So when you think about inflation, like as I mentioned, yes, there's a little bit more to go, right? So from the rates perspective, I'm thinking that the easy part of bringing down CPI from close to 9-10%, as well as core CPI from close to 8% down to about 2-3% where we are, the Fed must be very happy already. And that's the reason why they're cutting. Now, for me, I'm wondering whether are the risks really skewed towards the upside from now on? Because if you are thinking about even tighter labor market, if you're going to be restricting immigration, if you're going to be cutting taxes at a time when the US economy is still doing fine, right? Tariffs, yes, it's a one-off, but if a one-off together with 2 other upside risks, we might have a problem, right? So the issue from a risk perspective would be, have inflation, has it bottomed, right? Is disinflation behind us? And then if you look across the different measures that we have, we'll be monitoring quite closely to see whether this narrative that has been in play for the past 2-3 years, this disinflation, is it over? Right. So the next part, the labor market as well. This is something that where the data has been remarkably volatile. Right. So I think it is probably easier just to focus on the left-hand side chart, the red line, and that's the number of jobs per unemployed person. And the figure is just over 1, which is fairly healthy. Okay, so if you have too many jobs per unemployed person, then you are in overheating territory. And current levels are close to where we were pre-pandemic. So if you look at that, plus the radar chart, where the red line is slightly closer to the center, it just means that on the margin, the labor market is cooling, which is a good thing because we don't want a overheating labor market that drives up inflation. But are these numbers alarming enough to sound recession warnings? We don't think so, right? There was a bit of a scare in the middle of the year, but as we look through the data here, through all the hurricanes and the strikes, things are actually looking okay for now, right? Rather balanced, I would say. So balanced labor market with good inflation prints for the last couple of months, but upside risk, what should we expect? Right? So this is a chart, again, we've shown for some time. We are likely to see calibrated cuts. Right? So if you're going to look for the Fed to cut all the way down to 2%, 1%, 0%, it's very unlikely. Right? So I've also put the SORA there and MAS bills. They tend to go down together. Now, where should we be mapping the cycle to? So my sense is it's probably not one of those mega downturns. It's not going to be the pandemic type cuts, not the GFC type cuts. Right? We're probably going to be looking at the 90s kind of cycle, right? Which we thought would be fairly probable Because if you think about it, right, Trump introduces uncertainties, and at some point there might be conflict in objectives between inflation and growth, right? So then it becomes an issue of we are looking at a cooling economy, a cooling inflation, but that could change if Trump is successful in engineering some of the policies that he campaigned on, right? Then you will introduce a whole lot of upside risks. So then it will be a much messier cycle going ahead. So short end rates, this is where we are. We see terminal at 3.5%. Compare that to SORA, maybe 2.5, 2.6 terminal. Risk is probably tilted slightly to the upside. And if you look at how the market is pricing, so the red line is what the Fed is looking at back in September. It's looking a bit dated. So if you look at the dotted line, that is what the market is pricing. It's basically saying that the Fed will get to neutral sometime in 25, and in 26 we might be looking at some hikes. And what about the long end? So the long end, I think the issue here is whether the bond vigilantes will come back. Right? So bond vigilantes typically watch for stresses. Right? It could be on the budget. Right? Fiscal looseness could cause it. Could be on inflation. If inflation is too high, then bonds will sell off. So I think for the US, for the longest time, people have been willing to look through the budget issues. I think increasingly it is difficult to look through these issues. Some of the structural sticky kind of spending, Social Security, Medicare, they go up every year automatically, and there's no real intent to try and resolve the issue. And more recently, we have interest payments that's popping out in a big way. So if you look across the past 12 months, the biggest change is actually interest. Right? So how is that gelling with the budget position, high rates, and then worries coming in from treasury investors? Right? So there are quite a few flashpoints that could happen within the markets. And that, I think, will be a recurring theme, right? Not just for 1 year, but could be for many years to come. So, which is why we are somewhat cautious when we think about 10-year yields, and we are probably even more cautious when we think about 30-year yields. Right? So in terms of where we think the yield should be, we plugged it around the moderate growth inflation to the firm growth inflation kind of area, right? So if you look at our forecast, it's about 4.5. But if we go into overheating, right, because Trump's policies change the trajectory, then we could have 10-year yields going above 4.5. Now, these levels are not at crisis of confidence kind of levels, right? Because if we do get there for various reasons, then yields wouldn't be at 4.5 to 5. They would be much, much higher. But right now, it is too early to talk about such scenarios. So, yes, very volatile. When you look at the 5-year SOFR and SORA, we've got many different kind of narrative that drove markets up and down. Inflation is transitory, recession imminent, banking sector scare, Fed pivoted. And the most recent one was, the Fed is going to ease, and therefore interest rates across the curve will fall. So that turned out to be wrong because there are other drivers that move long-term rates. Right? And then, of course, Trump gives another kicker that proposed a lot of upside risk to both growth and inflation. Right? So I think the takeaway here is that even though easing has started, it doesn't mean that long-term rates will go down. They could actually go up. Right? So this will be my last slide. And I think there are quite a few things to ponder as we think about 2025, right? The US economy is very important, and so far it looks okay, right? And the post-election policies that Trump is going to introduce. And I think just between these and sticky inflation, potential rebound in the Chinese economy, and bond vigilantes, there are a few takeaways that we can draw, right? So one is there will be more rate cuts, but there might not be that many. Right? So accordingly, the neutral rate for the US economy might not be that low. Right? But for the rest of the world, depending on how they adjust to US policies, the neutral might actually be lower. Right? So it's not that clear. Right? For inflation, we think it might have run its course. Fiscal concerns will be increasingly important, and we should be more wary about the recurring theme of bond vigilantes. So if you guys got any questions, please submit them into Pigeonhole. I'll just let Liang take over.
I can assure you, Eugene, there are lots of questions, especially on the SGD space. So when Liang is done, we'll go through those questions one by one. Liang, go ahead, please.
Thanks, Simon. Thanks, Eugene. So for my section, I will discuss 2 C's and 1 D, crypto, China, and the dollar. So let's just have a quick review of what has happened to the Trump trades. By the very clear margin, we see crypto is the winner. Bitcoin is up 27%. We were expecting a lot of volatility post-elections, and that really has happened. We'll discuss why later. US stocks also generally stronger. The dollar on a DXY basis has risen by 1.5%. So that's largely driven by a huge bump up in the short end US 2-year yields, up by 12 basis. But on the flip side, actually, Chinese stocks didn't really do well. Hang Seng is down about 4.5%. RMB is down about 2%, which kind of underperformed relative to the other major currencies. So what about China? What does Trump's election victory means for China? So I'll discuss a little bit about that. But first on the dollar, what does it mean for with Trump presidency? Could we see a 2016 redux for the US dollar? So my view, or rather our FX strategist view, Philip's view, is that we could see a little bit of a stretch in the dollar in the short term, but generally, by and large, we should see it easing across the next year. First, on trade, what really matters is policy sequencing. I don't think we have reached a point where there's absolute policy clarity. Yes, tariffs are coming, but are they imminent? Probably not, right? So there are a few reasons why that's the case. The first reason, are they the most important priority for Trump? Probably not. We've seen back in 2016, the first thing that Trump was trying to push was a repeal of Obamacare, and then further on, it was really tax cuts and jobs act. So by and large, tariffs may or may not feature so much in the first year of his presidency. We think populist measures, maybe you could wait it out towards the midterm elections before you revive it as policy agenda. And the second thing really is also the fact that the dollar is a lot stronger. If you compare it back on a DXY basis, back with where it was 2016, is about 5% higher. On valuation metrics, it's pretty much in overvalued space. So to try to push the trade agenda, to push tariffs at this point, really could be a bit of a backfiring from the perspective of the dollar, because Trump doesn't want a strong dollar. Trump actually prefers a weaker dollar. He wants that to support the economy. So at this point, to try to push tariffs, I think it's likely to push the dollar even further into extended territory. So timing-wise, maybe not quite as good as before. So remember, back in his first presidency, tariffs only became an issue in 2018. That was in year 2 of his presidency. So by and large, we think a similar scenario could play out in this case, where really the policy agenda is not so much on trade. There will be some room for negotiations, but tariffs, even if they come through, could be layered in, not all in one shot. The only clear point which is positive for the dollar is really tax cuts, right? So as Timer and Eugene mentioned, as booster growth, likely keeping the economy on a more stronger footing. That's why we have also revised our dollar forecast. We're still expecting a softer dollar, but by a more gradual trajectory. So we revised up our dollar forecast. So euro dollar, we think, would end the year in at 111, down from previous levels. We still see slippage in dollar yen. Now it's trading about 156. We see it slipping below 140 by end of 2025. I'll touch on a little bit on RMB later on. So just to focus on the worst case scenario for the RMB, right? Let's say Trump is to introduce a 60% headline tariff on all of Chinese exports to the US. What does that actually mean for China? So our economics team has done a good job looking at Chinese exports to the US, and assuming that the entire tariff increase is about 49% incremental tariff increase is to be absorbed by Chinese importers, and that's assuming there's no trade diversion and there's no pass-through US consumers, then that could mean about 47% hit to Chinese total exports value. And if you look at it as proportion of Chinese GDP, is about 0.5 to 1% hit to growth, and that's really in the worst case scenario. So by and large, we think that the impact probably is not going to be too large. From that perspective, if growth outcomes are not so skewed on the negative side, then the RMB could still remain somewhat stable. But of course, it really depends on how the PBOC is looking at the RMB right now. And from the point of view, I think our chief economist, chief China economist, Mo has a great quote. She said that Trump cares a lot about China, but China doesn't necessarily care that much about Trump. And from the perspective, we could see that actually Chinese policy agenda is to really be stabilizing growth at this juncture. They are very worried about local government financing vehicles debt. They have announced just last week up to 10 trillion of local government bond quotas to be distributed over the next 3 to 5 years that will allow local governments to take on their balance sheets all this LGFE hidden debt. So that's primarily the policy goal, which is to stabilize growth and ensure credit continues to function. They are also looking at recapitalizing or rather providing more capital to Chinese banks, particularly smaller banks that are more exposed to the LGFE debt. So that's the primary concern. So from the point of view, stability will still be the main policy goal for going to 2025. To try to address that, I think there's still very much a weightage towards keeping RMB stable. You don't want a very volatile RMB that's going to create all sort of financial stability risks. So if you look at where the RMB has been trading since 2023, by and large, we see very stable dollar CNY fixings. So the fixing has been very stable from 710 to 720, not changing very much. And on a basket basis, the RMB basket has been relatively stable, about 98 to about 101. So we think that that's probably going to be a case. And the main reason is because the RMB is already quite undervalued based on the fundamental factors that we look at. There's not really a lot of need for PBOC to be looking at allowing further RMB weakness. Is really at a level that will be quite supportive for growth. And assuming that the tariffs do not actually happen next year, probably there'll be a bit more space for PBOC to try to keep the RMB more stable. But of course, risks from tariffs are very uncertain. This could still impact headline sentiment of the RMB. But we still think, by and large, we're not going to see that trade risk coming so soon. So how about the impact on Asian credit? So if you look at the chart on the left, we see actually US credit has huge rally, spreads really compressed, not just in investment grade US debt, but high yield debt as well. But in Asia, things are actually looking quite benign. So if you look at the Asian credit market, spreads has also narrowed a little bit. And I think primarily that's due to the fact that not a lot of China credit is exposed to external demand, so they're not that dependent on trade. A lot of this credit, they're more domestic demand oriented. And B, also rather than focus on what's happening on external front, markets are more focused on what is the amount of support coming through to the LGFV sector. As I mentioned earlier, the LGFV policy is such that there's more bring onto balance sheets of LGFV liabilities, and that's really helping to some extent to cap spreads. So if you look at the credit spreads for Chinese Financial Local Authority, which is a proxy for LGFV debt, they have been a bit higher compared to the aggregate credit spreads for China credit. So there's a lot of room for if you're issuing local government debt officially, that's going to bring down the cost of financing, and B, that's really going to be stabilizing sentiment because there's really enough resources, fiscal resources coming through to support LGFV debt. So we don't see risk of a public bond default in the LGFV space for next year. That's likely to be one of the reasons why Asian credit has done quite well post-Trump. And just going to round off with crypto, I would say, it's really difficult to say where crypto is going. Is 100,000 coming? Don't know, but there's given the volatility of crypto, there's no telling what could happen. So why did crypto rally so much? So if you've been following our Crypto Digest, you'll know exactly why that's happened. Trump has made it clear that he wants the US to be a crypto capital of the planet. So that means that regulatory attitudes are going to change. He has said that he's going to be appointing a new SEC leader, because the current leadership has been pursuing a very strict regulatory stance in the crypto space. That's, I think, to some extent, premature regulation has really helped dent innovation. So a more permissive regulatory attitude could perhaps be stoking greater adoption of crypto, could be fostering more use cases for crypto. That's by and large going to bolster crypto demand. So that rally in crypto is based on just that. The second point is that he wants to create a strategic national Bitcoin stockpile. Does it mean that the US is going to buy Bitcoin? No, but it means that the government will not be selling any of the tokens that it holds or acquires. So that's actually supply that's taken off the market. So positive for Bitcoin prices. And lastly, there's also a bill passed by the House earlier this year called the FIT21, which is Financial Innovation and Technology for 21st Century Act. What does it mean? It basically means that regulation of crypto, more or less, will be under the CFTC instead of the SEC in the future. And given the fact that there's a Republican sweep of the Senate and Republican presidency, what it means is that very high chance of the bill becoming law. If you look at the Stand with Crypto breakdown of support for crypto by parties, you'll see that by and large Republicans are very supportive of crypto. So that means that we could see very significant regulatory change. So this regulatory easing is another reason why crypto prices have done so well post elections. So with that, I will pass over to Timer for the Q&A session.
Thank you, William. Not all cryptos are made the same. Some are doing better than others.
Yes, and obviously part of it is due to betas, right? So the more mainstream tokens are doing okay, but the altcoins are really outperforming because they have a high beta. But I would still say that it's better to be focused on mainstream coins, because you don't want to be a scenario where there could be some kind of manipulative behavior, and also at the same time, liquidity as well as trading institutional interest is all more concentrated on the mainstream tokens, Bitcoin, Ether. So these are very, very safe assets as compared to altcoins where there's still a lot of unknowns out there.
Could you give us a sense of the ETF market situation with cryptos?
So ETFs were approved earlier this year. So Bitcoin ETFs, Ether ETFs, they're out there. By and large, I think the Bitcoin ETF has seen very heavy inflows, possibly with inflows outweighing inflows in the gold ETFs, which I think we discussed earlier. So the investor interest is there, but at the same time, volatility in this market, I think, is not something to be to forget. There's huge amount of volatility. It's 4 times the volatility of normal US equities. So there's a lot of hopes, and crypto prices are somewhat buoyant, but also be careful that volatility could come back if there's any shift in terms of what's happening on the political front.
You don't want to make any comments about crypto at 1,000, Bitcoin at 100,000?
So I think, well, I mean, 100,000 is not too far, right?
Yeah.
On a percentage basis,
Yes.
we've seen crypto making that kind of gains. But 100,000 is a psychological level. I think being a psychological level, there's always going to be some degree of I guess, profit-taking behavior happening around there. So we could hit it, but could we sustain? I think that's a big question.
Sure. William, I will switch to Eugene now. A few questions on Pigeonhole. Eugene, lots of questions on the US, as you can expect. So let's go with one. We're going to put it on the screen now. Do you see Trump's America First policy? Would it be inflationary? And then what does it mean for higher for longer?
Yeah, I think the issue here is whether Trump will be able to push through whatever he campaigned on, right? Whether it is the tightness that he wants from the immigration space, which if he succeeds will push up wages. And then the second part is on tariffs, which will have a one-off impact on inflation. And then we have the other part on tax cuts, right, which is basically quite similar to cash handouts. Right? This is a direct boost to companies if the cash gets flowed into the system. So if it goes according to the plan, then it does feel like there is scope for inflation and growth to be higher. The risks are, from the risk perspective, to the upside. And if you look at how the pricing has done in terms of break-evens and real rates, they have reacted that way. Now, then the question would be, how would the Fed react, right? So if they go back to the mandate, which is if the employment market is going to be tighter and if inflation is going to be a little bit hotter, then they would have to keep rates higher than they otherwise would have been. Right? That is the logical thing they should do. Right?
Eugene, we were discussing 3 scenarios for 2025 yesterday in our Teams chat.
Okay.
One scenario was Fed goes ahead and does what it sort of prepared the market for, which is regardless of what Trump does, it keeps on cutting in the first half of next year. Point being, it cannot change its policy based on something that Trump may or may not do. Legislation may be in the making, but it might take 3-4 months to pass, which might be enough time for the Fed to take the terminal rate down to 3.5% or something like that. But market then takes that in its stride and creates a melt-up scenario where we see, NASDAQ heading to 7,000 and Bitcoin, William's favorite commodity in the world, goes to 200,000 or something. And then we have a dot-com bubble type situation. And we have a disorderly adjustment in the second half of 2025. And then we have a stagflationary situation. Fed may want to cut, but from an inflation perspective, it can't, because the turbocharged economy, the melt-up scenario has spilled over from asset prices to consumer prices.
Yes.
But at the same time, we see the bursting of the bubble creating some impact on through negative wealth effect, through companies shutting down and job losses and so on. So that could be one risk scenario. We're not pricing that in, or not forecasting it, but we recognize the scenario. Another scenario is Powell goes and gives everybody a Christmas gift in December, but then the dot plot and everything that comes with it expresses some degree of uncertainty about 2025, which I think would be a sensible thing to do, but I don't think Mr. Trump will like it.
Yeah, I think that the issue here is that's what the Fed should do, and then what Trump would like, right? And sometimes the policies might not be consistent, right? So if Trump decides to exert pressure on the Fed, would that mean that the Fed keep rates lower than where it should theoretically be, given certain economic conditions? Then if that happens, would that lead to a much steeper curve, for example, because confidence gets lost, right? So if it's lost, it's not that easy to regain back because a lot of US debt is held by foreigners.
30% about?
Yeah, I think perhaps even
about 30%,
more, right?
yeah.
So there's a vulnerability there.
Okay, so related to that question, Eugene, I'm going to put this on the screen now. Which current level, this is an impossible to answer question, but it's a good question nonetheless, which is what level of US government debt is the financial repression endgame? I think what it's trying to say, the questioner, that at what level of debt GDP ratio is the US sort of forced to start doing QE, if you will, to hold down asset prices or something like that, or support asset prices?
Yeah, so I think that the level of debt might not matter so much as whether the investors still have confidence in the dollar as a reserve asset. Because I think that is the number one question, right? Because it is still the most liquid, and the US economy is still the largest. So in this respect, unless confidence deteriorates markedly, and that can happen if we have the US running fiscal deficits of 7-8%, which is a notch higher than where we are, 5-6%, even in good times. Or we can have the Fed, for whatever reason, deciding to cut rates, even though inflation is running at 3-4% and growth is running at 3%. Now then there could be a confidence issue, right? So should that happen for a prolonged period, then I think it doesn't matter whether we are at 100% net debt or 120% net debt or 80% net debt. The outflows will take place because there will be reallocation of where all the reserves are going to be parked.
Correct. Correct. Let's move to the Singapore SGS related question, Eugene. The question is about short-end yields, rather short to medium, 1 to 5 year yield. How do we expect them to move if the Fed does go ahead and cut all the way down to 3.5%?
Yeah, so I think the issue here is that if you look at where the SORA is, where it is now, the fixing is around 3%. But if you look at where the fixings were a few months ago, right? A few months before the Fed cut, they were closer to 3.6, 3.7. And you could argue that, well, we followed the US 1-for-1, right? Does it make sense? So I think there are different drivers that we have to consider, and one of them would be liquidity, right? So if the liquidity becomes more flush, then all else equal, Sing rates can fall more so than dollar rates. So
you're talking about Sing dollar liquidity, not US dollar liquidity.
Sing dollar liquidity. Yeah, so that can happen independent of everything else and could put downward pressure on Sing rates. Right, so the other thing to consider is that it is not possible for Sing rates to fall as much as US rates if the Fed decides to cut to zero, because there simply is not enough room, right? So the Fed goes from 5.5 and then they cut by 550 basis points. There's no way SORA can drop by 550 points because we don't really have negative rates, right? So I think we just have to be aware that there are different drivers, and in the short term, they can exert more pressure than usual. But if you look across the entire cycle, then things tend to smooth out.
And in terms of SGS supply or operation twists that MAS may not do, these are not major factors going forward, at least for 2025?
The supply of SGS has been, there's a lack of supply for these few months, right? So we were waiting the 2025 issuance calendar to add that in. So right now what we have is a situation where SGS trades somewhat rich versus treasuries and versus SORA as well. So when there's more clarity, especially on the long end, then we could see some opportunities start to appear. I think we just have to wait a couple more weeks before the calendar comes out.
Right. Very good. Let's go back to Liang momentarily. Liang, it's a deep question on US dollar. As Trump administration has tendency to strengthen the US dollar, while his intention is to push US export productivity, which is contradictory, how will this play out?
We discussed this before, right? So there's fundamentally it's not consistent because you have tariffs and the economy is strong. That means the Fed is not likely to be cutting through rates as much. The dollar is going to be strong, right? So there are a few ways you can go around to make a scenario like that happen, and one of which is through a coordinated international intervention similar to the Plaza Accord in the 80s. How likely is that to happen in today's world where politics is a lot more fractured and international financial markets are so much deeper, so much more liquid? Probably a lot harder. Trump can say what he wants, but the outcome is that he's probably not going to be able to achieve a weaker dollar if a lot of his policy that it pushes become were to be realized.
I also wondered, to your point, that if you can't do it through multilateral route, which doesn't seem to be something that Trump administration is interested in pursuing. I don't think they care much about the WTO or the World Bank, IMF, or anything like that. Big departure from the Reagan days in the 1980s when the Plaza Accord was pushed through. So then what can you do? You could take unilateral actions. You can say, I will raise tariffs even higher if you don't strengthen your currency. That could be one. But again, how China responds to that, I think, is anybody's game. China can say, well, you're making it very difficult for me to hold any US dollar assets. Let me start selling my treasuries. And then we have the fiscal crisis on top of the dollar crisis. That could be one issue. The second could be that the US then accuses countries that are sort of third markets through which Chinese exports are coming to the US. So Mexico, for example, South Asian countries, Vietnam would be another example. The countries which have seen a surge in Chinese investment in the last 5 to 7 years. So although China's exports to the US has gone down, those countries' exports to the US has gone up, coinciding with China's investment into those countries. So I can easily see a scenario in which Department of Commerce sends hundreds and hundreds of investigators, if you will, going through SITC classification of various goods and trying to see the rules of origin, export content, and if they fall foul of their scrutiny, then those countries also face a wider tariff war. something like that. But by and large, I think a strong tariff policy and somehow come up with ways to increase productivity inherently contradictory. You can protect your businesses, you can create jobs by keeping other jobs out, but that would mean your businesses that are in your country will be less competitive, lower margin. They just operate because they have a tariff shield around them. Good. Let's move on. Okay, so William, this is a very specific question on Taiwan dollar and broadly on our currency forecast. See if you can take a stab at this. Well, will USD TWD or any other Asian currency drop dramatically in 2025, just like they did in January 2017?
Right. I think it's important to remember what 2017 was like. So 2017 was a time when the global economy was starting to recover from a trade recession, right? So we have a global synchronized recovery. Trade was starting to pick up again after a very period of very subdued growth in 2015, 2016. So that was one reason for the very strong performance of export-oriented currencies, not just Taiwan dollar, but Sing dollar was particularly strong. And it was coming also at a point when the dollar was somewhat overvalued, just like where it is today. So to the point, can we see a repeat of that? Certainly, if we see a bit more pickup in global economic growth, we see strength coming through the Eurozone economy. And the Eurozone economy has been one place where actually growth has somewhat disappointed expectations. So we see a bit more of a stronger upturn in Europe, and trade tensions are not too elevated. So there's a lot of bluster, there's a lot of rhetoric, but actually we don't see too much of actual hikes in tariffs. Then that kind of scenario where we could see recovery in the Asian currencies, particularly very undervalued currencies, and will count all the Northeast Asian currencies to be somewhat undervalued this time. They could see a bit more scope for gains as what happened in 2017. But fingers crossed, we don't have a major escalation in trade tensions going into 2025.
Right. And you could also argue that if countries are fearful of action from the US, and the actual imposition of tariff doesn't really take place, especially if they cross about 10%, because there's some question whether even legally that's possible for Trump, then you might see the yens and the ones of the world rally in a way to sort of offset any further action from the US, that we're strengthening our currency, don't put on tariff, because if you do, our currencies will go down. But you want your currency to weaken, our currency to strengthen, do it. It will happen under the no tariff scenario. Some sort of an understanding like that could very well materialize.
Well, actually, something like that has happened when Japan and Korea have a joint agreement with the US Treasury, where they come out to say that the yen weakness and won weakness were a bit too extended and they are ready to support it. So
this was published in April of this year, right after the IMF spring meetings. I remember this. Yes, exactly.
Right.
Yes.
So there's a possibility where they could put out a public statement like this, and that could catalyze a bit of a recovery, because definitely yen and won, they're all very undervalued. Not necessarily because of China, but also by the fact that the rate differentials have become so wide, and that if we could continue to see a bit of compression and some policy rhetoric in support of domestic currencies, then that's definitely a scenario.
I can see Trump waking up at 3 a.m. one night and tweeting about Korean won and Taiwan dollar, and then we can see those currencies appreciate, and along with Japanese yen. We have run out of time. We have a few other questions. I can see where everybody's interest is. I think we need to come back later on in a month or so to address these questions. And these questions will stay with us. I think the dollar space, the rate space, the tariff space, we need to do a lot more work, and we need to come back to you over and over again. Thanks to everybody for dialing in today. We will end the live stream right now. Eugene, William, thank you very much. Everybody stay safe, stay healthy. We'll see you again. Have a great day.